Zero. Good afternoon, class. The purpose of today's brief lecture is to review the chapters that we're going to cover in the coming midterm. We are going to cover chapter 1 is a basic overview, so we won't have much from chapter 1. We will be covering basically chapter 2, 3, 4, 5, 6, and 7. So these are the chapters. These 6 chapters are going to be covered in your first midterm, which will be available after you come back from your fall break. So today I'm going to run down briefly on these 6 chapters, what needs to be paid attention to. So please go through this lecture and send me an email if you need help with any of the issues. I will probably try to have another session like this. And I'll try to make sure that session is live. Now in chapter 1, as I said, don't spend too much time on it because we already are covering everything along the line of chapter 1 in each of these chapters. So that was a basic introduction. So in chapter 2, we primarily got an exposure to financial statements. The only key thing that we are taking from that chapter is how to calculate the free cash flow. So just pay attention to the formula of free cash flow. How do we calculate that? We calculate free cash flow as first we take the net operating profit after tax, which is EBIT times 1 minus T. So it's the same thing. No PAT, no net profit after tax, minus you take the net investment on fixed asset let's call it FA, and take the net investment on net working capital. Let's call it NWC, net investment in net working capital. And we know that net working capital you get as current asset minus current liability, and you take basically the amount of net working capital this year versus the next year, and net investment on fixed asset you get as whatever the amount of your fixed asset is this year, and whatever net fixed asset you had on the previous year, the difference between that is your net investment on fixed asset. So that's pretty much the only thing outside getting yourself comfortable with talking about financial statements that you learn from chapter 2. So it's pretty simple. It's just few tedious versions of trying to find out how you calculate your fixed, your cash flows, getting yourselves familiar with income statement and balance sheet. Now in chapter 3, we basically use the knowledge that we learned from chapter 2. In chapter 3, we talk about different ratios. We categorized it into different categories. The first one we talked about is the liquidity ratios, where you calculate the current ratio. Let's call it CR. Current ratio is current asset divided by current liability. Then you have the quick ratio, where you subtract the current asset minus inventory divided by current liability. So these ratios allow you to know how liquid the company is. Then you have the asset management ratio, which gives you the efficiency idea, right? So in that category, you have the total asset turnover ratio, which is equals to sales divided by total asset. Then you have the day sales outstanding ratio, and so many other ratios that calculates the efficiency of your assets. Then you have what we call the leverage ratio. So leverage ratio, you can have different versions of it. One of the useful leverage ratio is simply to know what is the amount of debt you have, right? So the debt ratio is total debt divided by total asset. Total debt divided by total asset. And then you have debt equity ratio, DE, which is total debt divided by total equity. Then you have the equity multiplier, which is your total asset divided by total equity. So these all information gives you idea about where is your debt. Always you want to have more equity than debt. So these ratios allow you to know those things. Then you have different kinds of profitability ratio. Return on asset is your net income divided by total asset. Then you have return on equity, which is net income divided by total equity. You have gross margin, which is gross income divided by sales. So you have profit margin, which is net income divided by sales. So you can come up with your own profitability ratio. And then we have some market ratios, which is important because you want to know what people are valuing your stock, right? So one of the things that we have is PE ratio, price earning ratio, which is the price per share divided by earnings per share. Now earnings per share is simply equals to net income divided by number of shares, right? So that's one of the key ratios that you can use. Then you have the market to book value, the market value per share. So market to book is market value per share divided by book value per share. So these informations allow you to know whether the share price in the market is overvalued or undervalued. Now the key thing that I would like you to take from this chapter is what we call the DuPont ratio, right? So the DuPont ratio starts with return on equity, ROE, is equal to, we know that, net income divided by total equity, right? So if you look into this equation, you have the income and total equity, so you have an idea about, based on your investment, how much income are you getting, but that doesn't give you the whole picture. We talked about 5 different ratio categories. This ROE gives you information about just one category. So if you would like to incorporate more category over here, let's break it down. Let's bring in net income and divide that with sales. If you do that, you need to bring sales on the numerator as well, right? By total equity. Let's not worry about that. Now, net income by sales gives you information about your profit margin, PM, right? And we can do that because sales and sales will cancel out each other. So we have profit margin times sales And let's bring total asset here and multiply total asset on the numerator so it will cancel out and we'll have total equity. Now sales over total asset is what we call total asset turnover ratio, TATR. And this is what we call equity multiplier, which also gives us information about the leverage. So in other words, ROE is equal to profit margin times total asset turnover ratio times equity multiplier. So we have the profitability ratio, we have the asset utilization ratio, efficiency ratio, and we have the leverage ratio. So if your ROE is high or low for some reason, it has three components to look at it. One component is profitability, another component is efficiency, another component is leverage. So it can be high or low because of any of these three things. So this is one of the key formula that you take from chapter 3. Okay, so I'm not going into any examples, but there is another interesting thing that you can capture from here is what we call the growth rate, G, for any company. And the growth rate is simply equal to ROE times B divided by 1 minus ROE times B. This is what we call sustainable growth rate. And B is equal to 1 minus dividend payout ratio. Okay, that means if your net income is $100 and you are giving out $40 as dividend, your dividend payout ratio is 40%. So your B, which is the retention rate, we call it, and your growth depends on retention rate, would be 1 minus 40%, which is 60%. So that is another takeaway from this chapter. Now let's move forward with where we really started financial analysis, finance, from chapter 4, time value of money. So we started everything with the simplest formula of present value or future value, you want to call it. So let's see how we calculate the future value. We calculate future value as present value multiplied by 1 plus IR, whatever you want to call it, the discount rate, let's call it R, to the power N is the time, right? And another version of it, you can bring in present value equals to future value divided by 1 plus R to the power N. So that is the simplest form of calculating present value, right? For lump sum amount. If you are looking into an investment opportunity, today is time 0, 1, 2, 3 is different times, 1, 2, 3. So you are looking into an investment opportunity where you will be given $500 4 years from today. So that $500 is your future value. And if your opportunity cost, which is the market interest rate at your risk class, is, let's say, 10%, the present value would be equal to 500 divided by 1 plus 0.10 to the power 4. Right? So let's calculate that, see how much it is. 500 divided by 1.1 to the power 4 is equals to 341.5. $341.51. So that would be the present value. Okay? So this formula is applicable only if you have a lump sum amount, no payment in between. Now, if we break it down, this thing as in the next 5 years, somebody will be giving you 100, 100, 100, 100, 100 fixed amount every year for next 5 years. So 500, instead of getting at the end of the 4th year, somebody's promising you to give 500 in next 5 years, equal installment. We call this scenario as an annuity, same amount every time period, right? So for this present value, we'll be simply calculating each of the 100, which kind of looks like a geometric progression, we call it. The formula for present value for this is very simple. We are going to calculate the present value as the coupon we call the C divided by R, 1 minus 1 divided by 1 plus R to the power n. Okay, so C is 100, I is 0.10, 1 minus 1 divided by 1.10 to the power 5. So let's calculate it. It will be equal to first 1.10 to the power 5. That's the way I prefer to do it. 1.610. Inverse of that is 0.62. 1 minus the answer gives me 0.379 multiplied by 100 divided by 0.1 gives me $379.08. $379.08. So that is the present value of it. Now, what if this $100 annuity is given forever? We also have a thing for it. So if you do that, C divided by R, whatever you have, and n is infinity, so 1 divided by 1 plus R to the power infinity would be really small amount. So this whole thing will be, so this thing will be equal to 0. So eventually, we call that perpetuity. If you have a fixed amount of coupon given for entire life, we call that perpetuity. So the formula for that would simply be equal to present value for perpetuity will be simply equals to C divided by R. So in this case, it will be 100 divided by 0.10, which is equals to $1,000. Okay? So that's pretty much what we have covered in Chapter 4 in Time Value of Money. In Chapter 5, we have taken this to one extra step. We are calling it, we talk about bond. Now, what is a bond? A bond is a debt security used by corporations that has a fixed coupon payment, and at the end of the coupon payment, the principal amount is returned. So usually, a bond has a face value of $1,000. So when you purchase a bond, you purchase it at a face value, and then that bond has a coupon attached to it. Usually it's given every 6 months, but for our calculation, we'll make it 1 year. So every year you get the coupon payment, and when the time to mature comes, you get your investment back. So for bond, you have very similar to what we did over here. So let's say you have 10 years. Up till 10, you will be receiving 100, and on the 10th year, you will be receiving a face value of $1,000, which is your future value, by the way. So, in order for you to find the price, you will be receiving 10 coupon payments, for which you can calculate the present value exactly like the annuity formula that we use. The only thing that you have to add is you have to calculate what the value of that $1,000 that you'll be receiving 10 years from today, right? 1 plus R to the power n. That's it. So if you have the same information, $100 coupon and R equals to 10%. So if you do that, R equals to 10%. So you have 100, R is 0.10, 1 minus 1 divided by 1.10 to the power 10 plus 1,000 divided by 1.10 to the power 10. You will find that present value is exactly 1,000. Why? Because the coupon rate and the market interest rate or opportunity cost is same. Now, if this rate is increasing to 11%, now this is your opportunity cost. That means the market interest rate. If you were to invest on something similar to that risk class, what rate you would be getting. So if the market rate for your investment becomes 11%, however, you are getting only 3%, only 10% on your investment for next 10 years, normally you wouldn't like to get that. You would like to get more from the market, right? So your immediate instinct would be to sell that, right? So if you sell it and everybody else who is holding the bond tries to sell it, normally the price of the bond will drop, right? So you will see that the price, we call these discount bonds, would be less than 1,000, right? So when R equals to 11%, your coupon will be 100 divided by 0.11, 1 minus 1 divided by 1.11 to the power 10 plus 1,000 divided by 1.11 to the power 10. Let's see, how much is it? If you calculate it, so 1.11 to the power 10 equals to 2.83, inverse of that equals to 3.5. So let's write this down over here. So it will be 1,000 times 3.5 is going to be equals to 352.184445. Okay, let's write it down. So minus 1 minus that is 0.6478, right? Times 100 divided by 0.11 equals to 588.923 plus that plus 352.1845 is going to be equals to $941 and 1.11 cents, $941.11, because your market interest rate is higher. Now, on the other hand, if the market interest rate drops to 9%, the price of this is going to increase because everybody would like to buy this bond because this bond gives you better interest, right? So ideally, the price will be going up. Okay, so that's in a nutshell what we learned in chapter 5 in bond pricing. The only other thing that you have to keep in mind is that you have one special kind of bond which we call zero coupon bond that gives zero coupon. So the only thing that you have in this zero coupon bond is similar to the lump sum pricing. It will be 1,000 divided by 1 plus R divided to the power. And so that's the only thing you will be looking from chapter 5. Now chapter 6 is a little bit more challenging than what we have talked about so far. Chapter 6 talks about risk and return. Okay, so we will be looking into how we calculate the risk and how we calculate the return. So based on probability, for example, let's just keep into take a look at a scenario. You have, let's say, stock A and stock B. Okay, so stock A, let's say, is giving you 10% return. Stock B is giving you 15% return. Let's say that is under normal circumstance. Normal circumstance, and probability of that is 50%, right? So let's say there is 25% chance that it will be worse, right? So if that is the case, you will have, let's say, 5% return and you have 10% return, right? And if you have a best scenario, the chances of that is 25%, you'll have 15%, and you'll have 20%, right? So this is the scenario, right? So what is your expected return? Let's call it ER, expected return, right? The formula for expected return is sum of probability of I divided by the individual return, right? So over here it is 0.25 times 5 plus 0.50 times 10%. Doesn't really matter if you're using point or not, you can end up with the same result. Plus 0.25 times 15. Right? Over here it will be 0.25 times 10 plus 0.5 times 15 plus 0.25 times 20. Okay, so 0.25 times 5 is 1/4 of 5 is 1.25, right? So let's just use calculator instead of trying to mumble through here. So it will be equals to 0.25 times 5 plus 0.5 times 10 plus 0.25 times 15 is going to be equal to 10%, right? That's the expected return. 10%. And over here, again, it will be 0.25 times 10 plus 0.5 times 15 plus 0.25 times 20 equals to 15%. Right? So that is your expected return. So this is how we calculate the expected return for one stock. We call it standalone stock. Now what about the riskiness of these two stocks? We call it sigma. So let's call it sigma square first, then we're going to talk about the sigma. The formula for sigma square is simply pi multiplied by ri minus r hat or er, whatever we talked about, square, right? So we have, let's call it r minus r hat. So our average is 10%, right? So r minus r hat is 5% over here, right? Negative 5%. Over here it's 0, over here is positive 5%, right? R minus r hat over here is 10 minus 15, negative 5%. 15 minus 15 is 0%, and over here is positive 5%, right? So what about r hat square? So it will be 5 squared, 0 squared, and 0 squared, right? Square, square, square. Now multiply that with the probability and sum it up, we're gonna get our sigma square, right? So now remember, this 5 actually means 0.05, so just don't get confused about that. So let's just do that. 5 squared times, so our sigma for stock A would be sigma for stock A would be equal to 0.25 sigma square, not sigma yet. We're gonna calculate the root over for it. So it will be 0.25 times negative 0.5, sorry, 0.5 it is. 0.05 square is going to be equals to 0.0025, right? 0.0025 plus 0 plus 0.25 times 0.0025 again, right? And it's going to be the same for sigma B as well, right? Sigma B, it will be the same thing, 0.25 times 0.0025 plus 0 plus 0.25 times 0.0025, right? So we get equals to 0.00125, right? So that is the sigma square, sorry. So the sigma would be root over of that, square root of that. So sigma will be equal to square root of that, which is which is equals to 3.53%. So this is what we call standalone risk, right? So the rule is for the given return for standalone risk, if you're comparing two stocks. So this is basically the determinant of risk. So if you have two stocks that has the same return and same risk, like A and B, you are indifferent, right? If you choose any of this, you won't go wrong, right? However, if you have the same return, let's say, let me just take my word back. Over here, your expected return here is 10%, your risk is 3.53. Over here, your expected return is 15%, your risk is same 3.53 as well, right? So you have the same level of risk, but B is giving you higher return. B would be your choice, right? On the other hand, if you have the same return, the one with lower risk is what you are going to choose, right? So over here between A and B, a rational investor would choose B because the risk is same, 3.53 is the sigma, however return over here is higher, right? So for the given level of risk, you would be choosing the one that gives you a higher return. So that's how we calculate individual risks, right? You can also do the same thing for historic data. You don't have the probability. However, for historical data, you calculate the expected return as simply summing up the whole return, sum of the return divided by n, right? And standard deviation is simply sum of r minus r hat squared divided by n minus 1. You do because it's a sample, right? Now, whenever you have more than one stock in your portfolio, here we are bringing the concept of portfolio. You have heard the term don't put all your egg in one basket, right? So that means you try to put your eggs in different baskets. So if one basket encounters problem, the eggs will be saved on the other baskets, right? So over here you have number of stocks, and over here you have the sigma risk of individual stocks. So if you have one stock, you would have the highest possible risk. As you are keeping on adding stock in your portfolio, the portfolio risk is going to be diminishing until you add all the stock in the market. Your risk is not going to diminish any further, which we call market risk. And what is the diversification benefit? That's what we are going to talk about right now. Diversification benefit comes from the fact that how one stock is related with the other. We call that correlation coefficient rho. And rho we calculate as sum of between two stocks, let's call it RA minus R hat of A, okay, multiplied by R hat B, RB minus R hat B, okay? R hat A squared times sum of times R hat B squared. Sorry. This one divided by individual ones. Sum of R hat A times R hat A squared times sum of R hat B, RB times R hat B squared. So that is the relationship, okay? And the rho ranges from -1 to +1. It cannot be lower than -1, it cannot be more than +1. +1 simply tells you that the two stocks are giving identical return, right? So you are wasting time putting these two stocks in your portfolio because you're not getting any diversification benefit. -1 gives you exactly opposite return. That means when one is giving you 5% return, another one is giving you 5% loss. If one is giving you 10% loss, the other one is giving you exactly 10% profit. So that's what -1 is. And 0 means completely unrelated, right? So the reason it is important is that when you are putting two stocks in your portfolio, let's say you are making your portfolio with stock A and B, right? So you're putting 50% weight in stock A and 50% stock B, right? So your return of the portfolio, let's call it RP, portfolio return, will be your weight WA times the return of A plus WB times the return of B. And the sigma of the portfolio is going to be root over your weight of A squared times the sigma of A squared plus weight of B squared, sigma of B squared, plus twice WAWB times sigma A, sigma B, multiplied by rho between A and B. Now, if the rho is 1, you are getting exactly same return if you have added. If your rho is anything less than 1, your portfolio sigma would be less than when you have added those two risks. And if it is -1, you will have the maximum possible reduction in risk because of the portfolio diversification. So keep that in mind. Now, it's rational that when you are making portfolio, you will be eliminating the undiversifiable part of the risk. So we don't worry about the undiversifiable risk. We simply worry about the diversifiable part of the risk, which is related with the market, right? So it doesn't really matter if you have fully diversified or if you have all the stocks in the market, you still would have to bear the market risks. So everything starts with the market, right? So in other words, if you were to draw what we call the security market line, this is the security market line, where in your x-axis you have the market excess return, which is return of the market minus the risk-free rate. Okay, if you regress that with the individual stock return, return I, you get the security market line, right? Where beta is the slope of this line, right? So the relationship is that, and this is the intersection, which is the risk-free rate. So the relationship between individual stock and the market excess return is that Ri equals to risk-free rate plus the coefficient, which is the slope, beta we call it, times Rm minus Rf. And the formula for beta is nothing but it is the risk in relationship with the market. So it is the covariance with individual stock and the market. So let's call it I and M. I and M divided by the variance, which is sigma square of M, right? And covariance between two things is equal to rho times sigma I, sigma M divided by sigma M. So basically what you are getting at is beta equals to rho between individual stock and market times sigma of the individual stock divided by sigma of the market. So this is what your beta is, right? Now when your beta is exactly equal to 1, that means your return, your required return would be exactly equal to the market return, right? So in other words, beta will be 1 when the relationship between market and sigma is 1, and the sigma and this is also the same, right? So if your beta is, let's say, 2, that tells you that you are twice as risky as the market. If the market return is 10%, your return will be your risk would be twice as much as the market risk. So what would be your required return then? If your beta is 2, right? And let's say market return is 10%, RM is 10%. Risk-free rate is, let's say, 4%, right? So if that is the case, beta, if your individual stock beta is 2, you require 4% plus 2 times 10 minus 4, which is 4 plus 6 times 2 is 12. You require 16% return because you are twice as riskier as the market. So that's what beta talks about. So the sum of what we talk about in chapter 6 lies in this formula. This is what we call the risk-reward relationship. If you are twice as riskier or more riskier than the market, you might as well require higher return. Now, what is the significance of that? Let's say your beta is 2, you require 16% return, but the market is giving you only 15% return. That means that stock is overvalued. You're getting lower return. You need to sell that stock because it's not giving you as much return. On the other hand, if the market is giving you more return, let's say the market is giving you 17% return, that means that stock is undervalued, so you need to buy more of that stock. So that's basically what, in a nutshell, we covered in chapter 6. So the last chapter we will be talking about is how you calculate the price of the stock, right? So stock price, as we have talked about, is nothing but the present value of future expected cash flows. So for generally, if you have different models, the general model is, let's say, first model we talk about, if you're receiving a constant dividend. Dividend is the only form of cash flow you can get from a stock, right? Besides the other rights and everything. So if you're getting a constant dividend, let's say D, forever until infinite period, you are talking about a perpetuity, right? A fixed coupon that you'll be receiving every year. So your present value, your price, is going to be D divided by your required rate of return. How do we get required rate of return? Through the capital asset pricing model, which we talked about earlier, is equals to RF plus beta times RM minus RF, right? So let's say we are talking about return equals to 20%, R equals to 20%, and dividend equals to, let's say, $5. So the price would be 5 divided by 0.20, which is $25, right? Now, what if the dividend grows? What if the dividend grows? Let's say today, D0, you give $5 dividend, right? 0, 1, 2, 3, 4. Next year, you're seeing that it's increasing by 10%, so it will be 5.5, right? So next year, it will be increased by another 10%, 5.5. So let's call it 5 multiplied by 1.1, 5 multiplied by 1.1 square, 5 multiplied by 1.1 cube, and it keeps on going forever, right? So it is sort of like a perpetuity, but with a growth, right? So this is what we call Gordon model. Where do you find the growth rate? Remember in the first, in chapter 3, we talked about ROE times B. B is the retention rate, 1 minus ROE times B, right? If you're not giving out all your dividend to the dividend holder shareholders, if you're retaining some of it, that allows your farm to grow, right? Or it can be the historical growth. So whatever it is, so if that is the case, make sure that you don't worry about, so your price will be, Gordon formula is D1 divided by R minus G, right? So D0 is 5, but not D1. D1 is 5.5, right? So it will be 5 divided by 1 multiplied by 1.1 times 0.20 minus 0.10. So it will be $55, right? So that is the most widely used formula for calculating the price. But problem occurs when you don't have a constant growth of 10% or whatever percentage. Sometimes you have some stocks that grows really fast, but that fast growth is not what we call sustainable. You cannot have supernormal growth rate forever. So for those companies, what you need to do, or the formula that we talked about, P0 equals to D1 divided by R minus G, you can only use that formula as long as G is smaller than R. Because if your required rate is smaller than your growth rate, then it's not a sustainable growth rate and you'll get a negative price. So you cannot use this, right? So whenever your growth rate is higher than R, you might have that, but that will be for a short period of time. So let's take the same example. D0 is $5. D0 is $5, right? R is 20%. Let's say the first 3 years, G is 25%, right? That means 0, 1, 2, 3, 4, 5. So first 3 years, that means in the first year it will be 5 times 1.25, right? The second year it will be 5 times 1.25 squared. Third year it will be 5 times 1.25 cubed, right? After that, so from fourth year to infinite period, it will be, let's say 6% would be the growth rate, right? So in the fourth year it will be 5.1.25 cubed times 1.06. And then it will be this one times 1.06 squared and so on, it will go on and on, right? So how do you calculate the price on that, right? So first thing we need to find out here is that after third year, because you have a constant growth rate, so let's calculate the price in period 3. So first you need to calculate the dividend in period 4, R minus G, right? So the dividend in period 4 is $5 you started here, times 1.25 cube times 1.06, right? And then you have 0.20 minus 0.06. So let's calculate what this is. So that is your price in third period, right? So it is 5 times 1.25 cube times 1.06, which is 10.35. So D3, let's just write it down for future reference. D1 equals to 5 times 1.25. D2, 5 times 1.25 squared. D3 equals to 5.1.25 cube, which is equals to, and D4 equals to 5.1.25 cube times 1.06, which is equals to 10.35 whatever, right? Divided by 0.20 minus 0.06 equals to 0.14. So it is $73.93.97 or 94 cents, right? So that is the price in P3, right? So the present value of this guy will be the first cash flow, present value of it, plus the second cash flow, present value of it, the third cash flow, which is the dividend plus this guy. So let's find out what are the dividends, right? So 5 times 1.25 is the first dividend you will be getting, which is equals to 6.25. Second dividend is minus times 1.25 is 7.8125 times 1.25 is 9.766, let's call it, right? So let's add this guy with this guy as our third cash flow, right? So plus 73.9397 is going to be 83. So our present value will be 6.25 divided by 1.2 plus 7.8125 divided by 1.2 square, and this price plus this dividend, which is equals to $83.7055 divided by 1.2 cube. Okay, so this guy is equal to, divided by 1.2 cube, equals to $48.44 plus 7.8 divided by 1.2 square equals to 5.42. And then we have 6.25 divided by 1.2 as 5.20. So it goes to 5.20. So 5.20 plus 5.42 plus 48.44 equals to, our price is $59.07. So that would be, in a nutshell, the price of this particular stock, right? And that's pretty much, in a nutshell, what we have covered in Chapter 2, 3, 4, 5, and 6, right? Chapter 2 talks about financial statements. Chapter 3 talks about the analysis of financial statement. Chapter 4 talks about time value of money. Chapter 5 talks about the pricing of bond. Chapter 6 talks about risk and return, and Chapter 7 talks about pricing of common stock. Okay, so please go over with these basic things, review it. If you have any question, please send me an email. I'll try to make another session addressing your specific questions. Until then, have a good one. Cut.